All right, let's talk about Quest Diagnostics, ticker DGX. They just dropped their Q3 2025 numbers, and honestly, it's created a really fascinating puzzle for investors. We're going to break it all down.
So here's the head scratcher. On one hand, you have the news, a classic beat and raise. I mean, Quest knocked it out of the park, reported earnings way better than expected, and told everyone the rest of the year is going to be even better. But then, look at the market's reaction. The stock got hammered, down 3%. So what gives? Let's dig in, dissect the numbers, and figure out what's really going on here.
Okay, so first up, let's look at the actual Q3 numbers. And really, there's no other way to say it. They were just flat out strong across the board.
Let's start with the bottom line, right? Profitability. Quest delivered adjusted earnings per share of $2.60. That is a really healthy 13% jump from this time last year.
And look, this wasn't just some tiny beat where they squeaked by. They blew past analyst expectations by 9 cents. That's a solid 3.6% outperformance. Wall Street definitely wasn't expecting that. The top line, just as impressive. Revenue hit $2.82 billion. That's a huge 13.1% jump from a year ago. And yeah, that also easily beat what the street was looking for. But here's the real kicker. It wasn't just about this quarter. They also raised their guidance for the entire year. You know, it's one thing to have a great 3 months. It's a whole other level of confidence to tell the market, hey, this strength is going to continue. And that's exactly what Quest did for both revenue and earnings.
So the headline numbers look fantastic, right? But how did they actually do it? Let's pop the hood and see what's really driving this growth engine.
Okay, this is what I find really interesting, the balance. See, their growth didn't just come from going out and buying other companies. They posted a super strong 6.8% in organic growth. That means the core business, the stuff they do every single day, is just humming along, firing on all cylinders.
And this right here really shows you how well they're executing. Just look at these numbers. Requisition volume, that's basically the number of tests people are ordering, was up a massive 12.5%. Their operating margins got better, meaning they're making more profit from every dollar of revenue. And the cash flow, my gosh, the cash flow is staggering, up 57% for the quarter and more than 63% for the year so far. This company is an absolute cash-generating machine right now.
Now, numbers like these don't just happen by accident, right? They are the direct result of a long-term strategy that is, well, clearly paying off in a big way.
So what is that strategy? Well, management has this 4-pillar growth model they're running with. First, they're winning these huge outsourcing deals with hospitals. Second, they're making really smart, targeted acquisitions. Third, they're building out their own direct-to-consumer platforms. And fourth, they're pushing the envelope on clinical innovation. It's like they're building multiple layers of growth all at once. And this isn't just theory, okay? Here's the proof in action. Look at this Corewell Health deal. That's on track to be a billion-dollar business. The Fresenius partnership, that's serving 200,000 patients every year. And then there's the really cool stuff, partnerships with wellness giants like WHOOP and URA. They're literally plugging Quest's lab engine right into the apps that millions of people are using to track their health. It's brilliant. And the CEO, Jim Davis, he said it himself on the call. The goal is to become the preferred lab engine for these big wellness brands. They see this direct-to-consumer world as a massive opportunity, and man, they are going after it. Okay, so let's recap. Everything we've seen so far points to a company that is absolutely crushing it, which, of course, brings us right back to that central mystery, the market's really weird reaction. So you just have to ask the question, right? If the results are so strong and the strategy is clearly working, why on earth did the stock fall 3% on a day with heavy trading volume? It doesn't make sense on the surface. And this timeline really tells the whole story of the day. Before the market even opened, the reaction was exactly what you'd expect. The stock was up almost 3%. Perfect. But then, as the day went on, it just faded. And it faded hard, closing the day down 3%. That's a massive 6-point swing from the high in the morning to the low at the close. So what happened? The answer is likely a classic case of sell the news. You see, the stock had a great run-up into the earnings report, even hitting a 52-week high. So expectations were sky high. When the good news actually hit, it was basically a trigger for everyone who bought the stock in anticipation to say, okay, time to take my profits off the table. So here's our take, and this is the most important part.
We think this sell-off was purely a technical thing. It was about profit-taking near a high. It was not the market rejecting the company's amazing quarter or its solid long-term strategy. There's a big difference.
Okay, so with all that context, let's look forward. What's our call on Quest Diagnostics from here?
Plain and simple, our rating is outperform. We're looking at the incredible fundamental strength, the spot-on strategic execution, and what we think is a temporary dislocation in the market. We believe the real business performance here is going to win out and drive the stock higher in the long run.
So, what are the catalysts that could prove our thesis right? Here's what you need to watch for next quarter. First, any updates on how that big Corewell Health integration is going. Second, we want to see some early numbers on how many people are actually using Quest through those WHOOP and URA partnerships. And third, keep an eye on their advanced oncology test, Haystack MRD. Any progress there on the clinical or regulatory front would be huge. All right, that brings us to the trade idea. For us, the play here is a pairs trade. Go long Quest Diagnostics and short a basket of smaller regional lab companies. The whole idea is that Quest's massive scale, their deep investments in tech, and these new consumer deals are building a competitive moat that smaller guys just can't cross. We think they're perfectly positioned to just eat up market share from weaker competitors. So to wrap it all up, here's the bottom line. On earnings day, the market was pricing in a short-term trade. It wasn't pricing in the long-term, decade-long strategy. And that gap, that dislocation between fantastic performance and a negative stock price, well, that's exactly where opportunity is born.
And, of course, just a reminder that this is for informational purposes only. It is not financial advice.